All right, welcome back, everybody. Today is Wednesday, September 8th. Quick look in on the market here today. We did see some material reversals in the metals markets over the last 24 to 48 hours, specifically in the gold market. We did see gold rally pretty sharply off of the non-farm payrolls miss this past Friday. But then we did see a very sharp reversal to the downside. Yesterday, I believe gold was down about $35 on the day. We did see some more follow through here this morning. Gold got down to as low as $17.84. Did hold the support level, and we have since bounced here. We're about $10 off the low in the gold market. However, yesterday's reversal, you have to pay very close attention to that. That should not be taken lightly. You are starting to feel those near-term forces, bearish forces, start to come into play, especially with yesterday's candle on the downside. That was it's pretty ugly if you look at it on the chart. So gold, for it to start to do a little bit better, it's got to close back above 1809 in our opinion to see maybe another run at 1840. But we do think that ultimately going forward into the month of October, we could certainly see some more downside in the price of gold. We are starting to hear more and more about a Fed taper, obviously with the jobs number this past week. That kind of delays things perhaps another month, perhaps 2 months at the most, but eventually that taper is coming, and I do think you're going to start to see the market start to position for that well ahead of time. We already are starting to see the yields markets move. We got the 10-year move to 138 over the last 2 days. We are starting to see that come in a little bit right now. Interest rates are a little bit near-term overbought. Wouldn't surprise me to see a little more near-term downside in equities that would knock yields back to the downside. But we think on a pullback in yields, an uptick in the price of bonds, we think you want to be positioning short of U.S. Treasury bonds going into the end of the year. So September, October, historically, some very volatile months for asset prices. I think you want to start to try to look through that and see, look at how you want to be positioned for November, December into year end. And for us, that is short of U.S. Treasury bonds, and that is still long of U.S. equities, more specifically U.S. small caps. We do think the small cap index is going to lead the charge in the fourth quarter this year to the upside as it starts to chase interest rates on the long side. So that's all I have for you today. Feel free to reach out. We'll try to get back here with an update towards the end of the week. Tomorrow we do have the ECB that is due out, that we do think the ECB is going to be marginally more hawkish than the Fed was in their past meeting. And then, of course, on Friday we get the PPI number, and then next Tuesday we get CPI coming out, which is certainly going to shake some things up in the interest rate market. So we'll see you back here next time. Good luck to you. Take care.